Every bubble feels safe, until it doesn't. In 1929, people believed stocks could only rise. Families mortgaged everything. The Great Depression erased it all. In 2008, Americans thought housing prices could never fall. Banks sold toxic debt disguised as gold. When the bubble burst, millions lost jobs and homes. And today, the same story returns with a modern mask. Technology will keep markets rising forever. It feels different. But so did every bubble in history. The truth is simple. Bubbles never announce themselves. They look rational. They make skeptics look foolish. They reward blind optimism until the moment they collapse. So the real question is this: are we living through the biggest bubble in history right now? And if we are, how do you protect yourself before it pops? The American stock market keeps breaking records. The S&P 500 trades at valuations higher than almost any other moment on record, higher than the dot-com era, higher than the roaring 1920s. By historical measures, this is uncharted territory. But price alone isn't the full story. A deeper problem is concentration. For the first time, so much of the market's fate rests on so few companies. Apple, Microsoft, Amazon, Google, Meta, Nvidia, 6 giants carrying the weight of the entire index. Together, they're worth trillions. Together, they explain most of the market's gains. Strip them out, and the S&P 500 looks far weaker. It all appears unstoppable, a golden age without gravity. But beneath the shine, the structure is fragile. Imagine a skyscraper supported not by hundreds of steel beams, but by a handful of pillars. As long as those pillars hold, the building stands tall. If even one bends, the entire structure trembles. That's today's risk, a market at record highs set on a foundation that's dangerously narrow. And here's the trap. These companies aren't empty promises like many in the dot era. They are wildly profitable. They dominate global markets. They generate billions every quarter. That's why so many insist this time is different. Yet history tells another story. When too much depends on too few, the system grows brittle. One earnings miss, one unexpected regulation, one global shock, and trillions in wealth can disappear. Not gradually, violently. The illusion of stability is the strongest just before it breaks. This isn't the first time investors felt invincible, and it won't be the last. In the late 1920s, America was booming. Credit was easy. Speculation spread everywhere. People believed prosperity had no limits. Then confidence cracked, interest rates rose, and the market collapsed 83%. It took a quarter century to climb back. In the late 1990s, the internet promised to reinvent everything, and eventually it did, but not before investors paid the price. If a company had .com in its name, money poured in. Many had no profits, some had no product. When the bubble burst, the Nasdaq fell roughly 80%. The new economy became a graveyard of promises. Then came 2008. A different narrative, same pattern. Housing, people said, never falls nationwide. Banks offered mortgages to anyone, no income, no job, no assets, and stamped them safe. When default surged, the illusion collapsed. Banks failed. The S&P 500 sank nearly 50%. Millions lost homes, savings, and hope. Every bubble feels unique while it grows. The technology is new, the story is exciting, the optimism seems justified. But beneath the surface, the plot never changes. A balloon inflates. Confidence builds. Skeptics go silent. And then the pop. Sometimes the fall is sudden, sometimes it grinds on for years. The ending is the same. Euphoria turns to fear. Fortunes turn to ash, and generations carry the scars. History repeats, not because markets forget, but because people do. Every bubble carries its own excuse, its reason to believe. In 1929, the excuse was endless prosperity. In 2000, it was the internet. In 2008, it was real estate. And today, it's technology. The global market's fate now rests on a handful of names: Apple, Microsoft, Amazon, Google, Meta, Nvidia. These aren't fragile startups chasing dreams, they are empires that print billions in profit and shape culture itself. That's what makes this moment harder to see as dangerous. In 2000, many dot-com companies had no revenue. Some didn't even have products. Back then, speculation built castles out of code and confidence. Now, the giants are real, profitable, dominant, admired, and that makes their illusion more convincing. Investors say this time is different. The profits are real, the system sound, the company's untouchable. But that feeling of safety is exactly the danger. When too much power concentrates in too few players, the system becomes unstable. It doesn't matter how strong they seem, because even giants can stumble. One weak earnings report, one regulation, one disruption, one global shock, and the tower begins to crack. Since 2012, the S&P 500 has returned about 11% per year. But remove the 5 biggest companies, and that return falls to roughly 6%. Almost half the gains vanish. The illusion of broad prosperity hides behind the performance of a few. Even within that elite circle, one name dominates: Nvidia, the chipmaker riding the artificial intelligence boom. One company responsible for a disproportionate share of growth. That's not diversification, that's concentration. And concentration means fragility. Picture a bridge supported by a single column. As long as it stands, the bridge looks indestructible. But if that column weakens, the entire structure collapses. That is the hidden shape of today's market. History has a warning for every investor. "This time is different" are the 4 most expensive words in finance. Every generation pays to relearn that truth. Every bubble needs a pin, a single event that turns optimism into panic. But no one ever knows what that pin will be. It could be a small spark or a massive shock. Either way, it always comes. And today, the backdrop is already dangerous. The Federal Reserve may be cutting short-term rates, but long-term interest rates remain high, levels unseen since 2008. The 30-year Treasury yield hovers near 5%. That number isn't just a statistic, it's a slow poison. High long-term rates make mortgages more expensive. They suffocate indebted companies. They pressure banks already fragile. And they force Washington to spend more and more just to pay interest on its debt. Right now, the U.S. government pays over $1 trillion a year in interest, nearly as much as the defense budget. And history warns, when a superpower spends more on debt than defense, decline usually follows. At the same time, America's borrowing is accelerating. In just 6 months, over $1.6 trillion was added to the national debt, without a war, without a crisis, just unchecked spending. The more debt issued, the higher the yields demanded. The higher the yields, the heavier the interest burden. It's a vicious cycle, and the world is noticing. For decades, U.S. Treasuries were the safest asset on Earth. But for the first time since 1996, global central banks now hold more gold than U.S. bonds. Quietly, they're trading paper for metal. That shift whispers something profound. Confidence is fading. Confidence fading in the world's strongest economy sends ripples through everything. Money that once poured into stocks is now flowing toward bonds. Investors see high yields and retreat from risk. Liquidity drains from the system. The foundation beneath record highs begins to thin. Valuations are stretched, concentration extreme, confidence fragile, the perfect setup for a correction. It doesn't take a war or a crash to trigger collapse. Sometimes it starts with something small, a weak earnings call from a tech giant, a poor jobs report, or a sudden geopolitical flare-up. One spark becomes the pin that bursts the balloon. Corrections are not rare. They are the pulse of the market. Since 1920, the S&P 500 has fallen about 5% 3 times every year on average. Most investors don't even call that a crash. It's simply turbulence. Larger corrections, drops of 10 to 15%, are also common. They last about 70 days, long enough to test patience, but short enough to fade from memory when the next rally begins. And then come the bear markets, declines of 20% or more. They strike every 7 to 10 years, cutting roughly a third of the market's value and lasting almost a full year. 1 year of fear, 1 year of headlines warning of collapse. Beyond that lie the crashes, the rare, devastating ones that wipe out 40% or more. 1929, 2008, moments etched into history, reshaping economies and lives. In 1929, a decade of prosperity ended in days. The Great Depression lasted more than 10 years, rewiring global politics and faith in capitalism itself. In 2008, the crash shattered trust in banks, in regulators, in Wall Street's very foundation. The scars still linger. These aren't just numbers on charts. They are lives. Families losing homes, retirements erased, dreams postponed. That's why the phrase, "this time is different," is so dangerous. Every generation believes it. Every generation pays for it. The cycle never changes. Optimism grows. Euphoria takes hold. The market climbs higher than anyone imagines. And then, as always, reality bites. The question isn't if another correction will come, only when. The investors who survive are the ones who accept that truth, because crashes are inevitable. Devastation, however, is optional. You can't control when the fall begins, but you can control how prepared you are when it happens. Preparation begins with one thing: survival cash. 6 months of living expenses stored in safe, liquid assets, treasury bills, savings accounts, or short-term funds. In every crisis, cash is life. It keeps you from selling at the worst possible moment. It buys you time to wait for recovery. In 2020, when markets crashed during the pandemic, those without reserves were forced to sell at the bottom and missed the rebound that followed. An emergency fund isn't just financial protection, it's psychological armor. It turns panic into patience. Once you've built your safety net, the next step is diversification. Never let your future depend on a single market or asset. Spread your risk. U.S. stocks, global equities, real estate, REITs, bonds, gold, even Bitcoin. Each reacts differently when the storm hits. When stocks fall, the dollar often rises. When faith in the dollar fades, gold shines. When inflation eats cash, hard assets hold their worth. Diversification doesn't make you invincible, but it keeps you alive. Then comes discipline. Keep investing even when fear dominates the headlines, especially when fear dominates the headlines. History proves that the greatest rebounds happen right after the worst crashes. From 2000 to 2024, $10,000 invested in the S&P 500 grew 7-fold. But if you missed just the 10 best days, your return was cut in half. Miss 40 and you nearly break even. 7 of those 10 best days occurred immediately after the worst ones. Selling during panic means missing the recovery that builds wealth. That's why discipline matters. Buy when it feels wrong. Buy when others are selling, because opportunity hides inside fear. Markets test patience. They tempt you to quit. But wealth belongs to those who endure, the patient, not the lucky. Crises destroy the careless but reward the prepared. Preparation isn't just financial, it's mental. You can't predict the storm, but you can choose your behavior. Discipline beats emotion. Patience beats panic. Consistency beats chaos. Like a forest fire, Crashes look like destruction, yet they clear the ground for new growth. Markets do the same. They burn away excess, reset the system, and plant the seeds of renewal. Every collapse transfers wealth. It doesn't vanish, it changes hands. From the fearful to the fearless, from the impatient to the patient, from the unprepared to the ready. The real risk isn't the next crash, it's failing to prepare for it. Every dollar you save today is a silent worker, earning while you sleep, surviving every storm. When the next bubble bursts, and it will, ask yourself, will you panic or will you act with clarity? Because history rewards those who stay the course and destroys those who believe this time is different.